Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel L. Connon, along with Brianna Valesky. While Dennis takes a little bit of a breather there from the wild pre-market trading. Serge Berger on the line of the Steady Trader. Serge, how you doing this morning?
Good morning, guys. It's been a long morning already, I can tell you, after all that craziness in Europe. So ready for another cup of coffee.
So let's get to that. Now, where are you? I know you travel back and forth. Where are you trading and calling us from today?
I'm calling you from Florida.
For Florida. Okay. So do you get little like alarms that go off in the middle of the night and say, Serge, get out of bed. You got to go trade. Were you up trading? What do you do to alert yourself to this kind of trading action?
Yeah, I mean, this morning was a little extreme, right? So, as you know, I spent a lot of time in Switzerland. So, of course, with the news out of the SMB this morning, those people were calling me around 4 o'clock in the morning. And it's not so much trading in terms of taking on positions. It's more kind of risk management in case there was something that we weren't positioned for. But luckily, I'm not a currency guy. Otherwise, I probably wouldn't be talking to you right now.
So could you just I mean, you spend time over there, can you evaluate their move, what the implications are for our market, what its the implications there for your buddy Draghi, what the euro is going to do? Could you give us obviously the aftermath, we're seeing the markets decline that come back. Could you give us your analysis, please?
If you look at what's happening, I mean, Switzerland, the it's sort of a little dog in terms of GDP, but that little dog can really bark when it comes to currencies. So I see a massive, massive disconnect between, the size of the country versus the effect it can actually have on the broader market. If I don't know what other country besides the Fed and maybe the ECB would have to do something that can cause such a magnitude of move. So I think it's probably overdone, and I think it just speaks to the risk we currently see in the global markets. How fickle they really are. As far as the U.S. markets are concerned, we're continue to see commodities volatility, which has now trickled over into currencies volatility, and I think it's just a matter of time until we see some of that show up in equities as well.
And so overreaction here. The S&Ps go down to 1986. Now we're back up 4.5 points. I mean, so you're not a big currency trader, so it's not affecting you that way. Just what about the volatility in the market? You're the steady trader, Serge. How do you keep steady trading in this kind of market?
I think a lot of this has to do with perspective, right? So if you look at, say, the spies, right, they now have an average true range of about 3 points, which is about twice as much as they've had for the past, say, 3 years on average. So how do you stay steady? You take that into consideration, right? And you take a step back, you reduce your size, and you just kind of watch for a little bit, because this kind of volatility is not something a lot of folks are used to. I think that's the biggest thing. There's no reason to rush stuff. We're in the second week of January, guys. The second week of January, and people are freaking out over year-to-date performance. Are you kidding me? Unless you blew up on the Swissy this morning, that's a whole different story. But if you're just an equities guy, just quote unquote, there's no reason to freak out, you know. But I think beyond that, I don't know if you want to get into the morning routine, but that would be a whole nother
No,
thing to talk about.
that was actually the next thing. I mean, everyone has their their own discipline, their own style, and you wrote that article about your morning routine, and perhaps even on a day like this with the crazy volatility, if you have a routine that you stick to and a regiment, it's probably going to help you out in the long run. Could you talk about the article and also your morning routine?
Sure, I think a lot of trading, it's just like sports has evolved so much. I always take the analogy of golf. It used to be that golf was, a game played by a bunch of overweight out of shape white dudes. Today, there's not that many of those around anymore. And I think in trading, it's the same thing. I think you used to be able to kind of slump it around. And I think these days, the big picture thing is that it's all about performance. So if you can kind of become a more stable and organized person, that goes anywhere from your work ethic to your health, your gym routine to eating healthy. I think there's a huge part of what can really help you control your emotions better. So my morning routine really kind of starts with, actually a little bit of meditation in the morning. I'm not, I don't like to put on my yoga pants or anything, but I kind of just try to calm down a little bit, kind of move into, going through the headlines, having some breakfast. It's all very, very strict and the same thing every single day without any stress. Because I think the biggest problem for traders is that they, is basically volatility in anything from the markets to anything that's not in the markets, right? So if one morning you have, I don't know, a flat tire, that's an issue, right? So you need to kind of have your morning structured very, 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 very tightly. And you see that, by the way. You can look at a lot of interviews from some big asset managers and big hedge fund managers. They all have a very, very rigid morning routine.
Okay, and so then how do you translate it into the markets? Do you do a lot of your analysis at night, and then you see, what factors happen during the after hours and pre-market, and then make a game plan, or do you make that game plan at night and just try and stick to it, hell or high water?
I think, over the years you learn that it's all about having a game plan, but it's all about the flexibility of a game plan within certain standard deviations. And so from my point of view, yes, of course, you go through the trading day to the morning and the afternoon and you take notes all the way along. But I think it's probably more important what's happening in the morning to sort of overlay that to what happened the previous day or to your previous day's notes. So I think you have to combine those two things to give enough room for flexibility. I mean, for God's sake, if you're, again, a currency guy this morning, it didn't matter what plan he had last night, that plan is probably gone. So I think it's a matter of being able to merge those two plans from the day before in the morning.
Nick Shaheen made a good point yesterday, and what he said is this. Let's just give an example like the Bank America the earnings today. Even if someone gave you the earnings report and you knew what it was, I mean, so you don't even have a chance of making money,
No.
because of what, the moves by the algorithms that pick up the news and trade it. It's really hard. So unless you can find what you're comfortable with and what you're doing, I think it's very, very hard, to trade these markets, and it seems like you've come up with a plan. Serge, I want to ask you about just, your overall, and I was kind of thinking about this last night, with all the volatility, and I think about my longer term positioning in the market, and, I'm kind of a perma bear, but still have to have money in the markets. I mean, can you really get shaken out of this market here on the volatility and declines that we've had as of late?
Can you get shaken out of it?
I mean,
Wow.
what would make you think that, boy, this is like, a break of the December lows, a break of the Ebola lows was so far from there. Let's say I was looking at the December lows and we couldn't get there yesterday. Is that something, those December lows that we had in the S&Ps, if those gave way, would you, reevaluate, this long-standing bull market?
Yeah, I think the December lows are a good reference point. You can see we bounced off of there now a couple times, yesterday, and then also in the S&Ps particularly, and also on January the 6th. I have to tell you, I am much more and more looking at not just say the S&P. I mean, they've done this for years, not just looking at the S&P, but I think it's really important these days because the S&P 500 is being used by, thousands of hedge funds globally as sort of the risk on, risk off tool. So the way the index trades can be totally different to how it should trade versus say the broader stock market or even say the Russell 2000. So I think it's really difficult to just look at the S&P if we were to break a trend line. Yes, I think the October, and you can look at the October move, right? That V-shaped move.
Yep.
I mean, by just about every measure, the S&P broke uptrends and uptrends and uptrends, right? But 2 weeks later, we were back where we were 2 weeks prior in October. So it just shows you that going purely off of technical basis on the S&P is a little bit silly. I really think you have to take into consideration what's happening in global macro, from commodities to currencies, because I do think the structural underpinnings of this market is shifting. And I think this morning's example from the S&B in Europe is probably about as good an example as we can see.
Okay, let's shift over to the commodities markets, and boy, crude has been in the news. What a move today! I'm not sure what the implications are from what the Swiss did, but people have been trying to pick a bottom in this thing forever. Now you're getting this kind of mad, crazy buying here, up 262. Have you been trading the crude market, or if not, have you been trading any of the oil stocks?
Yeah, no, very much so. I have been my go-to vehicles in that space is basically the OIH ETF.
Yep.
It's a good one, and I look at crude right now, or oil in general, up about 5%, just going vertical as we speak. A lot of it has to do with the dollar, right? So you see the dollar index this morning off about 23 basis points, and much more so over the past couple of days. So that inverse relationship is really important to watch. It's very difficult to trade oil or oil-related stocks if you just totally ignore what the dollar is doing, right? If you look at the XLE, for example, yesterday, very purely technical speaking, a very nice um, intraday bullish reversal, right? Sort of piercing below, I guess were those the December lows on the XLE? Just having a
Yep,
quick
yep.
look.
It looks like it. Wow, I think it was I don't even know if it pierced it, but let's
Pierced
just.
it intraday, yeah. It pierced the
Oh,
mid-December
it
lows
did.
intraday, rallied back. So from my point of view, if we now see a little bit of follow-through buying for a day or so in the XLE, and I wrote about that this morning, I think then you could see a nice move back into the high 70s. It's a reflex move. And again, you probably need a weaker dollar for that move to be sustainable, even for a multi-week basis.
SF Bright TG is making a point here that you had the rollover, you had expirations of the contracts yesterday, and
Mhm.
sometimes people don't get the full roll on, and you can have a little bit of a spillover effect. But just hit
Sure.
51.27.
Mhm.
We get a couple questions coming out of the chat here. If you have your charts available for us,
Mhm.
could you take a look and just give us a quick analysis of CDW? We got Rob Hood in the chat asking about it. CDW
Mhm.
Corporation. I'm not sure if you're familiar with it, but
Sure.
just from give us your technical take.
Yeah, I mean, for one, just keep in mind, guys, it's earnings season. Let me have a quick look when this thing reports. All right, so we got about a month until this thing reports, so that's okay. Technically speaking, I think for one, you have a tech stock. So once tech stocks come out and report, this thing will probably see a little bit more volatility, but it still looks okay. I mean, quite frankly, it's been choppy along with the broader market over the past few days. So I'm not quite sure it's something you want to go all out crazy for. But if it can kind of make some of yesterday's losses good and get back to where it was on Tuesday, where it
Yeah.
kind of spiked higher and failed that breakout. I mean, you'd stand a chance of this thing then actually being able to creep higher. But look, the bigger picture point of view, and I'm all for going through these single stocks, is the correlation right now in this volatility uptick is going to be very high.
Yeah.
So, you know what I mean?
Yeah, I know. It's hard to, look at, I mean, there's a lot of things going on in overall markets. Hurt Capital made a good comment on this one, and he employs the reversal plus four rule. If it doesn't trade back above Tuesday's high, gets back up there and close out the trade,
Hmm.
that's just because it just came off that high so quick. Also,
Yep.
I'm looking just under the $36 level. That was major resistance. Had that pop up to 36.92, but have had only one close over 36, and that was 36.28. So we'll keep an eye on that one. And then one other issue that just get your quick technical take on ZBRA. Another tech stock, kind of the same chart here, Rob Hood. You had the spike up. Are you familiar with this company at all?
I'm actually not familiar with Zebra Technologies, but yeah, you have a stock here that, through the bigger lens is sort of acting in very well. It's, making a series of higher lows and higher highs, and it's above all those moving averages. You can see the 200 to 50 and 100 are all kind of coiling up around the same spot around that, 73 to 75 area. So it's quite supportive. The question here too is it really worth chasing something like that higher after it's had 3, 4, 5 up days, and then yesterday kind of, you know, slumped along with the rest of the market. So technically, if it can get back to, I would say we're like 82.50 or so where it was on Tuesday, then you might get a chance of it moving into the high 80s. But again, here too, I would be very mindful of what the broader market's doing because it's most likely going to act along with that.
Yeah, and Rob, I would just, Rob Hood in the chat, I just keep an eye on 80.40. Had a low yesterday at 80.43, a low at 80.39. If that's taken out, a lot of real estate down to
Yeah.
the low on last Friday at 78.84. So if you're playing it close to the vest here, perhaps on a longer term trade, keep an eye on the 80.40 level. Well, Serge, we just have a minute left. We've covered a lot of things here. Do you just have any final words of advice for our investors traders as they try and tackle this volatile market today?
Yeah, look, guys. I mean, I think after a 6-year cyclical bull market, and we've talked about this on the show in the past, after a cyclical bull, you're bound to get, if not a cyclical bear market, at the very least a more volatile market. And I think all the signs or all the writing is on the wall that at least the first half of 2015 could see a lot more volatility. And that goes again from equities to commodities to currency. So I would play it a little bit closer to the vest, reduce your position size, and stay steady.
Yeah, that's I mean another thing too that you're reiterating is when there's more volatility, you don't need to trade the same size because you're going to get more movement in the issues you're trading. So that's great advice. We've been on the line with Serge Berger. He's a Market 5 maven and the author of The Steady Trader. Wrote a great article earlier in the week about his morning routine and staying grounded in this crazy market. Serge, thanks for joining us and hope to have you back on again soon.
Thanks so much, guys. Take care.